this week is big for earnings. We should expect to see many swings up or down in our holdings. This week for earnings season, though, is bigger than the rest for one particular reason. The mega tech giants are all reporting their earnings. We have Google, Microsoft, Meta, Apple, and Amazon. We also have some fintech up-and-comers releasing, such as Coinbase, Robinhood, and SoFi. And restaurants don't want to be left behind, as McDonald's, Chipotle, and Starbucks are all ready to roll. The week is rounded out by processing giants Visa, MasterCard, and ADP. What a whirlwind this week will be. But today, we are focusing on what I believe is the most undervalued of all the tech giants. Welcome to the Quality Investor. With all these earnings out this week, there will be a lot for us to track. Today, I am talking about Google, or Alphabet if you prefer, ticker GOOGL. But before diving in there, I also want to tell you what to expect the next week or so. I want to do updates on Visa as well as assess what is going on with Starbucks. I did a video on Starbucks a few months ago where I said they were one to stay away from because they were drifting further away from what made them great, what their core was. And that core was the coffee shop experience. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. Soon after that video, activist investor Elliott Investment Management had built a sizable stake in Starbucks, which culminated in the hiring of Chipotle's CEO, Brian Niccol. He was tasked with turning it around. And in his letter to the Starbucks community on September 10th, he stated exactly what I had claimed. Quote, "There's a shared sense that we have drifted from our core. We have an opportunity to make the store experience better for our partners and in turn for our customers." So I want to give an update after the new CEO's first earnings release. But back to the topic of today's video, Google. The tech titan has faced scrutiny in the last few months, which has led to a bit of stagnation in its stock price. After racing up above $190 per share in early July on the back of a blowout Q1 2024 earnings, the stock tumbled after a judge ruled that Google violated antitrust laws to dominate the search advertising market. Regulators claimed Google's $20 billion annual payments to Apple for rights as the default search engine on iPhones is anti-competitive. Now, a trial must take place to determine what remedies the federal court will order. The scariest aspect of all these remedies? Part of the proposed remedy framework by the DOJ includes a breakup of the business. This means divestitures of Chrome and Android. The federal government has a high burden to prove breakup is justified. However, I believe two things are certain pertaining to this court ruling. Google will face some sort of penalties by the court, and this will take a few more years to resolve once you factor in appeals. As an investor, this is something to definitely keep an eye on. Chrome and Android belong to Google's services segment, which is the largest segment. It is hard to determine exactly how much Chrome adds to Alphabet's overall revenue, but we can assume it is quite a bit given Google search generated $48.5 billion in Q2 from search alone, or 57% of revenue. Despite what happens though, I believe the real strength of Google is shifting away from search. While it will take a while to materialize, I believe GCP, Google Cloud Platform, and YouTube will emerge as Alphabet's main growth drivers. I discussed this in my deep dive video into Google's business. Check it out in the description below. There's a bit of market trepidation right now surrounding Google, But in my view, the recent price stagnation continues to offer Google to savvy investors at a very reasonable price. Before earnings this evening, the stock traded at a forward PE of sub 20 and an earnings yield of over 4%. They also have a trailing 12 free cash flow of over $60 billion. So they will easily absorb any fines imposed by our intrepid Department of Justice. And without further ado, let's dive into this earnings report. We'll look at this quarter's growth over the prior year and assess if they are still growing at a fast enough pace in the high margin areas of the business to warrant us to continue buying at the current valuation. Google did it yet again, another huge quarter for their earnings. In fact, post-market, it's up nearly 6%. If this sentiment continues into tomorrow, we can expect a pretty nice jump. And I don't see why that sentiment's going to slow down at all. Total revenues for Q3 increased 15% year over year. Services revenue was up 13% year over year. And what I think is going to be the main driver in the years to come, Google Cloud Platform increased a massive 35% year over year. And digging a bit deeper into segments, especially Google advertising business, they had revenue of $65.9 billion compared to analyst projections of $65.4 billion. So they beat not only on the top and bottom lines, they're beating in their segments as well. Google is crushing expectations right now. This quarter was Alphabet's best sales figure ever. The $88.3 billion in revenue topped the $86.3 billion from the 2023's fourth quarter. And they had the best profit they've ever had, topping the previous record of $23.7 billion with net income of $26.3 billion. I said earlier that YouTube is going to be one of the main drivers for Google in the next few years, and YouTube certainly did not disappoint either. YouTube advertising revenue jumped $8.9 billion this quarter, up from $7.9 billion a year ago. That's a 12.6% increase. And all in all, Google's subscriptions, platforms, and devices business, which includes YouTube TV, NFL Sunday Ticket, and YouTube Premium, among other things, had revenue of $10.6 billion, up from $8.3 billion a year ago. Just a tidy little jump of 27.7%. And it just gets better for YouTube. CEO Sundar Pichai noted YouTube's total ads and subscription revenues came in at $50 billion over the past 4 quarters for the first time. Executives said that short-form video creation continues to thrive on YouTube, noting that of all channels uploading to YouTube each month, 70% are uploading shorts, with 70 billion shorts watched daily. You see, they're going directly after TikTok here. And with TikTok's troubles regarding potential divestitures due to some legal wrangling by the DOJ, we could see a nice boon for YouTube Shorts if things don't go very well for TikTok. And getting NFL Sunday Ticket last year was a big coup for YouTube TV. So the company also recently began its second season of NFL Sunday Ticket on YouTube TV, which continues to receive a positive reception from advertisers, our partners at the NFL, and fans. But importantly, advertising commitments were up 20% year over year after the company's upfront presentation. Turning to Alphabet's income statement, we can see year to date, they had $253.5 billion in revenues, up 14.7% year over year. But more importantly, these margins keep getting better. Operating income was at $81.4 billion. That gives us a 32% operating margin. A year ago, at $60.6 billion in operating income, we were getting a 27.4% operating margin. Year over year, margins are up 460 basis points. That's incredible margin expansion. And I want to touch on that a little bit more. What is driving that expansion is Google Cloud Platform. Last year, in 2023, GCP finally became profitable. And since then, it's been like a rocket ship in terms of profitability. Not only are we seeing strong growth on the top line in revenue, you can see that here, $11.3 billion this quarter compared to $8.4 billion a year ago. Very nice 35% year-over-year growth. Look at the Google Cloud operating income. $266 million with an M 1 year ago, compared to $1.9 billion with a B today. The operating margin for GCP this quarter was 17.1%. 1 year ago in the same quarter, 3.1%. GCP is finally scaling, and that scaling is providing Google some very nice operating leverage. To put this margin expansion in context, year to date, GCP operating margin is now at 12.8%. In the same 3 months in 2023 for GCP, it was only at 3.6%. Let's look at Google Services for a second, though. In the first 9 months of 2023, they had a 35% operating margin on Google Services. Year to date in 2024, however, a 40% operating margin. So both of Google's main segments are expanding margin very well. And I believe in the Google Services segment, that's where YouTube lives, that margin expansion is being driven by that subscription model of YouTube TV and YouTube Premium. I even pointed out in the deep dive I did on Google that YouTube is the most watched streaming service there is, even more than Netflix. So right now, YouTube and Google Cloud Platform are two hidden gems within the Alphabet conglomerate. And these two areas are really going to drive Google forward, especially if we see some stagnation in the ad search area. And I'm not going to speculate on what's going to happen with the whole search business, but it is facing competition from Meta and even Amazon. And speaking of Amazon, right now, AWS, Amazon's cloud platform, has an operating margin of about 36%. Like I said, year to date, Google Cloud is only at 12.8%. So as GCP scales, it's going to become far more profitable. It may not reach Amazon's 36%, but as we'll see in a second, even getting up to, say, 20% operating margin could mean very good things for Google's future. So looking at what they're doing quarterly here and seeing if they're tracking with their year one, they're pretty much right on par for our revenue. $88.2 billion in revenue this quarter. Operating profit of $28.5 billion. Again, tracking to what we expected here at about a 32% operating margin. And that record net income they had this quarter is helping us get nearly a 5% beat on what our projections were for this year. And free cash flow came in at $17.6 billion for the quarter. We're not tracking exactly for what I expect for 2024. I think it's going to come into about $60 billion, or pretty much stay flat with last year. That means they have to get free cash flow in Q4 of about $13 billion, which I think is very doable. They had some huge investments in Q4 of 2023. So right now that trailing 12 number is being pulled down a little bit by that Q4. But everything is trending very favorably for Google at the moment. But I want to show you the assumptions I'm making by year 10 for their margins. Right now, Google Cloud makes up about 11% of Google's income. I'm projecting them to grow on a base case about 13% per year. Google Services makes up about 89% of Google's income. By year 10, given my growth projections for Google Services against what the growth projections are for GCP, Google Services should make up about 84% of income versus GCP's 15% of income. Now that may not seem like a huge jump, but we also have to consider margin expansion. It's scaling better every single quarter. If GCP, their operating margin scales up to what AWS is at Amazon right now, about 36% by year 10, and Google Services stays flat at about 40%, and Google Services creeps up maybe to 42%, or a 2% jump from what it is right now, that weighted average is going to give us about a 41% operating margin. So I'm basing my base case actually on about a 42% margin for Google Services going forward, and a 20% operating margin for Google Cloud Platform. That's a 38%. And then on the bull case, assumes more like they're going to get up to what Amazon's numbers are doing. A 40% operating margin. And then the bear case operating margin's at 36%. Google's phenomenal balance sheet. They barely have any debt, so they have very low interest expense. And right now their free cash flow conversion, it's a bit low. It's about 64 cents for every dollar net income. And that's due to the massive investments they're making right now into GCP. Google is certainly making big investments. In fact, they announced recently a partnership to build a nuclear power plant, which of course they're going to need for all these cloud services. Massive amounts of power that it takes to run these things. So I don't think we're going to see that free cash flow conversion creep up to what the 5 and 10 year averages were, but 88 cents to 90 cents on the bull seems reasonable. You can see here the revenue segment growth I have for each of the segments, but total revenue I have growing on a base case at about 9.4%, 11.9% on the bull, and at 7.4% on the bear case. Their 5-year CAGR, by the way, is at 17.5%. So I'm being very conservative for the next 10 years in my revenue growth projections. Keep that in mind when we see the final numbers. I do expect the operating margin, like I said, to really increase as GCP scales. And as far as a free cash flow margin, base case, it's coming out to about 28%, which is historically in line with Google's free cash flow margin. It's low now because of the massive investment they've been making for GCP. And on a bull case, up to about a 30.5% free cash flow margin. Google closed the day at $169.68. Their new earnings per share is now $6.97, bumping up their PE ratio a little bit to 24.3. They're trading right now to 24.3 PE ratio. I don't think the market is recognizing yet how powerful Google Cloud Platform can be as a growth driver. They recognize it in Amazon, and we're going to see a comparison there in a second. So it's a little bit below their 5-year average and well below their 10-year average. The forward PE is now at 22. Again, right in the middle of their 5 and 10-year averages. My bear case DCF model gives us $182.41 per share. I would not be surprised tomorrow if we see Google's share price rise to that level. Base case, $230.08 per share, and a bull case of $301.13. Dividend discounts at $145.28 on the bear, $193.79 on the base, and $275.50 on the bull case. The exit multiple, the comparison with their peers, $272.25. The comps I'm using for Google are Meta, Microsoft, Netflix, Apple, and Amazon. To give you a little bit of context around why that exit multiple price is so much higher than what they're trading at right now, the average PE of those companies is 39.06. Now, if Google was trading at Amazon's PE ratio, and Amazon, the bulk of their business right now is retail, which is a tiny sliver of a margin for Amazon. AWS is growing fast for Amazon, has a 36% margin. And right now, the market is giving Amazon a 50.5 PE ratio. If Google is trading at Amazon's PE ratio, Google will be priced at $351.99. If you think that's a little unreasonable, let's look at Microsoft, which is trading at 38.5 PE. That means Google's share price would be at $268.35. But maybe they're more in line with Meta, straight advertising, and that's going to be the bulk of Google going forward. Meta's at a 27.7 PE, meaning Google's at $193.07. No matter how we look at it, Google is massively undervalued compared to its peers and compared to the actual cash flow they're generating. I cannot believe how Google is trading at such a reasonable price right now. On a bear case, their upside is at 15%. On a base case, 36.5%. And on the bull case, nearly 70% upside. Without any margin of safety, the buy price is at $236.55. The 20% margin of safety, $189.24. The last few weeks they've been trading at $165. The last few weeks they've been trading the $160 to $165 range, which is a 30% margin of safety on this valuation. Google is a steal right now. We'll see what they do when the market opens tomorrow. If they have a gangbusters day, they might scrape 189. We'll see. But either way, I think this is a great buy up until about $200. And if they have another blowout quarter again for Q4, it's just going to push the valuation even higher. Google is a free cash flow machine, and it's only going to get better as GCP scales, YouTube grows, and they continue their dominance in search. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.